Going into 2 o'clock this afternoon, the market had already priced the Federal Reserve at better than 2 to 1 for a hold and roughly 1 chance in 3 for a hike. At 2 o'clock, the committee held exactly the result the room was positioned for. Then the S&P 500 spent the rest of the day falling to a 1-month low. This is the Algo Index market close for Wednesday, July 29th. The thing worth understanding tonight is that the rate decision was not what moved your account. The mover was the 30-year Treasury yield, which ran up to 5.2% in the hour after the announcement, its highest reading of the year, and it pulled equities down with it. Stocks lower, government bonds lower, the dollar lower, and gold holding above $4,000. That specific mix is what an inflation worry looks like, not a slowdown. The index closed near 7,316, off 1.5%. The Nasdaq lost 2% to its own 1-month low, and the fear index pushed back above 20. One promise, and I will spend the rest of this earning it. By the time we finish, I am going to put you inside the exact minute the afternoon turned, 3 o'clock at a single price, and show you why the rally that ran into it was never getting past. Everything between here and there, the yield, the desks, and the one line that capped the whole session, feeds that moment. Take the numbers cold first, then the reading. The S&P 500 finished near 7,316, lower by 1.5%, on a day that traveled 185 basis points top to bottom, more than 2.5 times the 72 the options market had charged for protection that morning. That is the first tell. Today was 2.5 times more violent than the market paid to guard against. The Nasdaq fell 2%. Semiconductors led the way down, and the fear index rose back above 20. Positioning stayed defensive, with puts running ahead of calls at 1.28 by volume and 1.34 by open interest. And pull the frame back one stop. Stocks, bonds, and the dollar all fell together while gold rose, 4 assets that rarely travel as a set. And when they do, it is usually because the worry is prices, not growth. This is the part to slow down on, because 3 forces stacked up today, and each one carries a number. Start with the one that pulled the trigger, the long end of the bond market. The 30-year yield jumped 2.2% to 5.2%, a fresh high for the year. The vote is why. The committee held the rate, but 3 of its members dissented, and all 3 wanted to hike, not cut. A hold with 3 officials pushing to tighten is not a soft hold. It's a signal the inflation fight may not be finished, and the bond market read it that way inside of minutes. Higher long yields are a direct discount on every future dollar a stock earns, so equities followed the yield straight down. Second, the dealer hedging flow, and this is where the day's shape comes from. Real-time hedging demand actually held this market up through the middle of the session, roughly $10 billion of it supporting prices from about $12.20 to $2.50 in the afternoon. Then, around 3 o'clock, that support rolled over. Broad selling took the wheel, and nearly all of today's flow sat in same-day contracts. The fastest decaying kind there is. So once the buyers stepped back, there was nothing slow-moving left underneath to catch it. Third, the gamma condition, which turned an orderly slide into a steep one. Dealers are carrying negative gamma, with the level where their hedging flips sitting at 7,385, and a pocket of that negative positioning stretching down to the 7,000 strike. Beneath the flip line, dealers are forced to sell as the market falls, which feeds the very move they are trying to offset. So when the 3 o'clock rally broke, the same desks that had propped the market up spent the final hour selling into the drop. One honest note, because keeping score on myself is part of the job. Last night in this seat, the base case we walked through said a hold would most likely relieve this market higher, towards 7,500. The hold arrived. The market did the reverse. And the reason is exactly what we just covered. The outcome everyone watched was not the one that mattered. Now walk the session with me, because the whole day pivots on one price. Cash open near 7,418 and ground lower all morning into the low 7,350s by noon. Then the 2 o'clock decision lit a relief rally, and it built for a full hour, 7,405, then 30, then at 3 o'clock on the nose, it printed the high of the day, 7,450 and change. That is the minute I promised you. Look at where it stopped. 7,450, to the tick, is the risk pivot our end-of-day options read, had flagged as the line dividing bullish from bearish, and it had already turned this market back once earlier in the day. The rally ran flat into it and could not get through. From that 3 o'clock high, the index fell about 130 points into the closing bell, printing the low of the day near 7,314, right at the close, and that is the lowest this market has traded in a month. The clean map that falls out of it, overhead 7,450, is the wall that has now rejected two separate rallies. Below it, the gamma flip line at 7,385 is the switch between calm and chase. Under that, today's low near 7,314, and then the primary support shelf at 7,300. The loudest options positioning today was not a single stock lottery ticket. It landed on the index itself, 1 hour before the Fed. At about 1 o'clock this afternoon, someone opened 13,000 contracts stacked on the 7,290 put strike, a full hour ahead of a call nobody could make with confidence. I want to be careful here, because the read does not tell us whether that was a hedge or an outright directional wager, and I am not going to pretend it does. But the placement is the story. 13,000 contracts parked at a strike well below the market, right before the event, and the afternoon then chased straight down toward it. Sitting alongside it was an 8,000 lot two-sided structure whose lower boundary, near 7,325, was broken through into the close. The point is not who collected. The point is that the serious money spent the hour before the decision preparing for the exact zone this market fell into. Let me put a frame around the fear, because it is not what you might assume. The price of protection by rank is sitting near the middle of its ear, not the extreme, so nobody was paying up in a panic today. And yet the session delivered 185 basis points of movement against the 72 the options market had charged for that same-day protection. Read it plainly. The market was underpricing its own event by more than 2 to 1, and this afternoon it collected the bill. That gap did not come from stocks alone. The cost of insurance firmed across the whole surface as bond market swings spilled into equities, which is the through line of the entire day. For tomorrow, the options market is now pricing roughly 147 basis points of intraday movement, noticeably wider than an ordinary session, and it is doing it right into the single most important number on this week's calendar. Our desk finished 3 wins and 1 small loss on a 200-point day, and I would rather give you the honest version than the flattering one. 2 shorts caught the morning grind lower, one for a little over 16 points, one on the Nasdaq side to a clean target. 1 long, a counter-trend try into the late morning, was simply wrong, and we cut it for 8 points, a small deliberate loss taken quickly instead of nursed. Then, when the 2 o'clock rally broke out, we took a single long into the pop for 7.5 points and stepped aside before 3 o'clock, which is the whole reason we were flat and not long when the market gave those points and 100 more straight back. Single leg and defined risk, every one. 7 other setups we passed on outright, and nothing was lost to a plan that never fired. What made the day work was not a hot hand. It was a map that named 7,450 as the ceiling hours before price arrived there, and the discipline to quit trading the long side the instant that level rejected the rally. Tomorrow does not ease off. It escalates. At 8:30 in the morning, the government prints second quarter growth and the Fed's preferred inflation measure in the same instant. And that one release gates everything that follows. Core inflation is forecast to tick down to 3.3%, and growth to land near 2%. But sit with the setup for a second. That cooling is expected the morning after a committee where 3 officials voted to tighten. So the real danger is an inflation number that runs hot against a market leaning the other way. After the close, Apple and Amazon report, so anything you carry into the afternoon decays into 2 of the biggest earnings prints of the season. Here is the 2-sided map that release drops into. Pulling up, the one-day options magnet sits at 7,400 and the monthly at 7,375, both above tonight's close, a mechanical tug higher. Pulling down, the negative gamma pocket that ran today reaches all the way to 7,000, and it accelerates any break. The bias turns constructive only if the gamma flip line at 7,385 is reclaimed and held. It swings to the sellers on a clean break of 7,300, while dealers are still carrying short gamma beneath it. One thing I cannot settle for you tonight, whether the bond market is pricing a genuine inflation problem or just repricing how long the Fed stays parked. Tomorrow's 8:30 number is the first real word on that, and it lands before the opening bell. 2 footnotes from after hours. The biggest software company beat and rose about 2%. The biggest social company missed and fell about 11%. So the mega-cap slate is already split down the middle. And strikes on Iran were confirmed tonight, but futures had been told to expect them since this morning, and made a fresh overnight high after the headlines crossed. So the market is treating it as already paid for. Crude up more than 6% today. 2 tools and a place for the rest. On your way out. The AI journal we build is free to open at members.algoindex.com/off/signup. And it marks any trade you record against the prices that were truly on the board the instant you clicked. The level scorecard sits in public at algoindex.com/tools/gamma level accuracy, kept out where you can see it on the days it helps us and the days it does not. Tonight's full write-up is posted at algoindex.com/blog, and the community picks it apart together over on Discord. Now, where to aim your eyes in the morning? Skip the index first thing. Start with the 30-year yield, because it led today, and stocks came along behind it. And until that number cools, it is still the one steering the car. We will be right here to read it with you.